Good morning, ladies and gentlemen, and welcome to the show. Glad to have you guys here on this Friday, the 18th of June, 2021. Thank you for tuning in. Now, you know what? What this latest problems in the market right now should show people is that the markets are not completely controlled by the Fed. Not completely, but the thing is this whole thing that's going on in the markets right now, with the markets all falling, gold price, everything's falling off except for the dollar. Big rally into the dollar, big rally into the bonds and everything else, is all being driven by fear. They're worried about a rate hike 2.5 years from now? What a joke. 2.5 years from now, we'll be in the middle of a hyperinflation. And they're worried about a rate hike. Ain't gonna happen, guys. But by that time, the Fed will be in full, well, it'll just be a mayhem. But the Fed will be more than likely, instead of hiking rates, the rates will probably be below zero. Or there will be some sort of a reset or something. I mean, over 2 years from now? Are you guys kidding me? Anyway, there's fear in the markets over statements that were made about a rate hike. There's still this thing out there where they think that the Fed can control all this, and the Fed's going to raise rates or whatever, and everything. It's just a fallacy. It's completely utter boulder dash. But anyway, it's generating fear through the marketplace. And this fear is a self-perpetuating, self-feeding cycle. Once it gets going, it's like you ever tried to start your lawnmower, and you pull the cord, nothing happens. You pull the cord, nothing happens. And when you pull the cord and you hear that, the engine's starting to fire a little bit, right? One of those times you pull the cord, it starts to fire and it gains momentum, and then the engine starts to actually run. It's like a flywheel, A flywheel works off the same principle. And this is the same thing. That's what's happening right now. But I think it's going to conk out. Because it's all being driven on fear. And it is a self-feeding, self-perpetuating cycle. So it's a little bit hard for me to predict exactly how big this will grow. But I think if it peters out, it's going to peter out suddenly, and I think it will peter out. In other words, it'll stall, like when the engine stalls. And then we'll go back to, people will start buying the dip, and everything will start to go back up again. I think that's what we're kind of headed towards, because there's really nothing behind all this. This is premature. You heard me say it's premature, because I'm expecting something like this, except bigger, coming in our future, not too far away. But what we're going to see first, when the real big one hits, much bigger than this, much more powerful, is we're going to see the U.S. 10-year is probably going to be substantially above 2%. And that's what's going to be the real trigger, is interest rates are going to be going up. And the Fed will have let them creep up, and there's nothing much the Fed can do about it. The interest rates on the long end of the yield curve, and it's going to start to burst the bubbles. But that's quite a little ways ahead in our future before that happens. The rates are going to creep up to that point, probably heading toward the end of this year and early in the next year. So I'm really not expecting it until probably in the next year before the real one hits. And it's going to be a crash, a real crash. Not this. This is a premature. I don't think this is going to amount to that much. I think we're going to pull out of this. In other words, what I'm telling you guys. And pretty soon. And so the people that are by the dip on everything are going to do all right, And the people that are piling into the dollar, that's going to be a reversal, And so they're moving in the wrong direction with this, I think. But with fear, things that are generated from fear, you never know for sure. It could continue to grow, and fear breeds more fear, Anyway, let's take a look at the markets and take a look at this and see what's going on with it today. So let's start the charts right here and get right in there and take an actual look at what's happening. We're seeing the gold price settling off. Now, the reason why gold is settling down and we're losing on gold, even though we've taken massive cuts in gold the last few days, is because on the 28th of this month, Basel III is coming into effect. And I'm going to tell you guys what, there's probably going to be a huge reversal in gold and silver once that time hits. But how they're driving it down by selling paper short contracts. These are unallocated gold positions. And these unallocated gold positions, they got to get out before Basel III comes in, because it's going to be a major change in the way banks look at gold and gold futures contracts. They're going to penalize them for holding unallocated positions. And it goes into effect, I guess, in Europe on the 28th, and then it's going to go into effect in the United Kingdom, which is big gold market, come the first of this year coming up. So this is an ongoing thing. It's not going to be in full effect, really, until the first of next year. So we possibly could see, well, we're going to have to wait and see how profound the effect is, but it's going to take until the end of the year before we really see the full effect of Basel III policies that are coming in right away. So gold's at $17.71 right now. It's down $2.10. Let's take a look at silver. Silver's at $25.96, and it's up 6 cents. They're both suffering really bad right now. If you're going to get into these metals, get into the real thing. Make sure you buy physical, and make sure you take it into your possession. Make sure you don't store it away in a let somebody else hold it for you. In other words, because we're coming to a time in the future where counterparty risk is going to be extremely important, because the system is going through it completely. This is a completely unstable system. Well, you can see by what's going on right now that we're in an unstable financial system. Take a look now at cryptos. Cryptos today are, let me see, they're dropping some, but they're trying to hang on. Bitcoin is at 38,827. They're trying to hang on, cryptos are right now through this. This is a bit of turbulence we're going through in the financial system right now. Take a look at the Dow. It's down 500 points today. And they're extending their losses in the Dow. I'm expecting a reversal. I honestly think it could come at any time. You know what I mean? And we could go into a little bit of a rally back up again, because this is the whole thing. This whole thing is there's nothing to it. Right now, it's just fear that's driving it. What happens when the fear suddenly turns to greed? If it just starts to go up a little bit, if things start to go up a little bit, that fear and a lot of traders and stuff is going to suddenly turn to greed. You know, and it could change the course of this thing very, very quickly. Will this thing deepen? Well, maybe it will, and that'll create more fear and start to swing it toward fear again. So it's swinging like a pendulum right now, back and forth. But because there's no actual reason for it, really, other than a few statements the Fed made about an interest rate hike that's like over 2 years away, it's ridiculous, you know? Because the system right now is awash in money. It's just a little bit, it's a reaction to fear, this whole thing, but it's an exaggerated reaction to fear. It's like there's a fear out there that everything's going to crash. And when they start seeing it crash, then that reinforces the fear, and then they start to sell, you know? And then they get more frightened. And then it's just, like I say, it's a self-perpetuating, self-feeding cycle. So we're down 479 points on this. Let's take a look now at crude oil, 71.93 right now. And it's up. This is a good indicator. In fact, that crude's starting to go back up again. But, you know, there's a lot more driving going on and stuff, and the economies are starting to rebound. They're starting to use more crude. And so, this is a good indicator, though. 71.93 for crude, and it's up 1.25%. Now let's take a look at the The move index. The move index is down 2.27%. But we see on this chart it's turned and now it's moving upwards, actually. Let's take a look at bonds and rates. Now, here's something I want to clarify. The U.S. 10-year right now is still down below 1.5%. We're not going to see the big crash until this U.S. 10-year is above 2% and heading toward 2.5. It's going to be up. It's going to be a lot higher than it is right now before we're going to see it really crash, you know. This is the biggest indicator of all. It's this U.S. 10-year Treasury, and it's at 1.455 right now. It's down 5.6 basis points today. So we got a falling bond yield. And the bond yields are going to stay down. Fed's not going to let them climb too high. But it's going to take the crash, I think. Probably at the earliest, probably toward the end of this year. Maybe early next year. There's going to be a big crash. It's going to be a real crash. It's not going to be like this. It's not going to be a flash in the pan like I think this is. It's going to be a real crash, and we're going to see the bond yields start to soar. They're not going to be low like they are. It's going to move the long end up, and the Fed's going to have to take action to stop it because it's going to be the real thing, you know. And they're going to move in. That's going to trigger what's called yield curve control. Probably going into next year. Probably by the middle of next year, we're going to have yield curve control in place. And that's when you're really going to see your hyperinflationary tendencies in the economy. I've been telling you guys all along, second quarter next year, that's when we start to enter into the real stuff. It becomes really obvious to everybody that we're hyperinflating. And then that leads to the same thing that's causing this. You see how this is happening right now with it feeding itself as a self-perpetuating cycle, and everybody's fear of deflation, and they're out there selling. It's going to be exactly the opposite of this when the hyperinflation actually hits, because it's going to be a self-perpetuating, self-feeding cycle in the opposite direction. Everybody is going to be getting rid of their dollars. Today they're all buying dollars. They're all going to be getting rid of their dollars as fast as they can when that day comes, you know. Okay, but that's a ways away. It's probably in, at least, just very soonest, toward the end of this year, probably in the next year sometime. But I've been predicting it the second quarter of next year, you know. That's when everything is going to really, what's I think's really going to trigger this hyperinflation is a deflation first. And the reaction to that deflation is what's going to trigger the hyperinflation. And so a crash is coming. The crash is going to happen first. And you're going to be able to see when that crash happens by watching the U.S. interest rates. They're going to climb. They're not climbing right now. This is a premature crash. You got to watch these interest rates on the long end of the yield curve. Everything from the 1 year out. You know, you got to watch them, especially watch the 10-year. And I don't think the crash is going to occur until the 10-year gets to around 2.25 or higher. We're only at 1.45 on the 10-year right now. Premature. It's all premature. Okay, now let's take a look at the U.S. dollar, and they're all rushing into it like mad because they're scared. And look at it go up, 92.34 right now. They'll all come out just as quick once this is over. The world's financial system right now, they sense something big is coming. And they're scared. They're really scared. And that's why you see capital and liquidity, you're seeing it run from one place to another. Because there is a crash coming. And the crash is what's going to trigger the hyperinflation. But the crash is deflationary. And so there's going to be a very short period in time when all these people out there who follow a deflationary principle, in other words, they believe that we're going to really deflate, There's going to be a very short period in time when they're going to be correct, and they're going to feel vindicated. And they're going to say, where's the hyperinflation? But it's that deflation that's going to trigger the hyperinflation. Because the deflation doesn't know where to stop. If the Fed didn't take action, the deflation would eat the entire economy to pieces. Because all the money is just built on a house of cards. It's all fugazi. And it can all disappear, evaporate. And the entire economy can completely melt down. This is the Fed's greatest fear. And they have an unlimited printing press. So at a certain point, they will react to the deflation if it's bad enough. And that's what's going to happen. And that's why the deflation is going to trigger the hyperinflation, because it's that reaction of the Fed, or should I say overreaction by the Fed, to instate new monetary policies and new fiscal policies that's going to trigger the hyperinflation. Listen, guys, thank you for listening to the show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.